Stocks soared on Friday in response to the April payroll report. The report itself was largely in line with expectations. Payrolls bounced back after a very weak report in March, and the unemployment rate fell to 5.4%, which is the best level we've seen since early 2008. Now, within the report itself, however, there were some signs of softness with overtime, hours worked, and average hourly wages all disappointing to the downside, suggesting that although the job market's been healing, we're yet to see the impressive wage inflation that everybody's been waiting for. As a result, investors seem to be pushing back their estimate of when the Federal Reserve is going to finally raise interest rates in this cycle. Earlier this year, everybody was kind of focused on the June policy meeting as the timing window for a rate hike. That's since been pushed back into September, and now as a result of Friday's numbers, the futures market's putting a 51% probability of a rate hike in December. So if we continue to see softness in the data, we could be talking about early 2016 before the Federal Reserve really feels compelled to raise the price of money. Now, another thing that's kind of corroborating this is that although the first quarter GDP number was very soft and looks like it's actually going to be negative outright after a very weak trade deficit report this week, second quarter data as it's coming in has been rather soft as well, with the performance in May sort of disappointing. So we're kind of in a Goldilocks scenario right now where the economic data is weak, but it's not too weak to threaten corporate profitability too badly. And we're still seeing steady gains in the job market, not yet seeing wage inflation. And all this means that the Federal Reserve is going to probably be patient in the months to come about any kind of policy tightening. So continue to watch the data very closely going forward, but at this point it's looking like kind of a not too hot, not too cold, just right environment for investors.